The 2026 Iran-Israel war that began on February 27, 2026, has created one of the most volatile market environments of the decade. As of March 8, 2026, the conflict involves coordinated U.S.-Israeli strikes against Iran, with significant impacts on global financial markets. This guide provides practical, evidence-based strategies for investors to protect their portfolios and identify opportunities during this geopolitical crisis. What this guide covers: understanding how the conflict impacts your investments, defensive strategies to protect your capital, gold, bonds, safe havens, offensive strategies to profit from war sectors, defense, energy, commodities, portfolio allocation for different risk levels, psychological discipline, and common mistakes to avoid. Understanding the current conflict and market impact. What's happening? The 2026 Iran war involves coordinated U.S.-Israeli strikes targeting Iranian military infrastructure. Israel's stated objective is regime change in Iran. Key developments include over 400 targets struck in western Iran, Iranian retaliation against U.S. bases and the Gulf states, closure of the Strait of Hormuz, 20% of global oil flows, and attacks on energy infrastructure in Qatar and Saudi Arabia. How markets are responding? Equities, the S&P 500, initially declined with investors rotating into defense and energy sectors. Oil surged with WTI crude jumping 9.5% in a single day. The Strait of Hormuz closure is the key variable affecting energy prices. Defense stocks, companies like Lockheed Martin, RTX, and Northrop Grumman have seen explosive gains of 12 to 18%. Gold initially fell 3.17%, breaking its historical safe haven pattern, though long-term outlook remains positive. Part 1. Defensive strategies. Protecting your portfolio. Cash reserves, your foundation. Establish a cash reserve of 6 to 12 months of expenses. This provides stability and flexibility to capitalize on opportunities during market panic. Cash allocation breakdown. Emergency fund, 3 to 6 months, cover essential expenses. Opportunity fund, 3 to 6 months, buy undervalued assets. Total liquidity, 10 to 20% of portfolio. Gold, the premier safe haven. Despite short-term volatility, gold remains the most reliable long-term safe haven asset. Historical analysis shows gold averaged 8.98% gains over 12 months during conflicts. How to invest in gold. Physical gold, bars and coins. Gold ETFs, GLD, IAU. Gold mining stocks, GDX, GDXJ. Recommendation: allocate 10 to 15% of portfolio to gold as a long-term hedge. Swiss franc, the stability currency. Research confirms that the Swiss franc demonstrates superior protection compared to gold and treasury bonds during geopolitically driven crashes. Switzerland's neutrality and strong banking system make CHF attractive for wealth preservation. Swiss franc strategies. Currency exchange holdings, Swiss franc denominated bonds, currency ETFs tracking CHF. Bitcoin, the digital safe haven. Recent academic research shows Bitcoin ranks as a robust safe haven against equity crashes driven by geopolitical events. However, high volatility makes it suitable for risk-tolerant investors only. Bitcoin considerations: 24/7 liquidity and global accessibility. Superior performance during geopolitically driven crashes. Recommended allocation: 2 to 5% for diversification. Government bonds. U.S. Treasury bonds offer capital preservation, predictable income, and liquidity for rebalancing. Recommendation: 20 to 30% in short to intermediate term treasuries, 2 to 7-year maturities. International diversification. Consider Swiss government bonds, German bunds, and Singapore government securities. Geographic diversification. Store assets in neutral, stable jurisdictions. Switzerland, secure precious metals storage. Singapore, strong rule of law. And Canada, independent regulatory framework. Part 2. Offensive strategies, profiting from war. Defense stocks, the clear winners. Defense and aerospace companies have demonstrated exceptional returns during conflicts. Historical performance: Gulf War, 1990 through 1991, defense stocks outpaced S&P 500 by 30%. Ukraine conflict, 2022, defense index rose 12% while the S&P 500 fell 19%. Iran War 2026, defense stocks surged 12 to 18% above general indices. Top defense stocks for 2026: Lockheed Martin, F-35 fighter jets, missile defense systems; RTX, Raytheon, missile systems, radar technology; Northrop Grumman, NOC, advanced aerospace systems, cyber capabilities; GE Aerospace, fighter jet engines, maintenance services; L3 Harris Technologies, communication systems, electronic warfare. Defense ETFs for diversification: iShares U.S. Aerospace and Defense ETF, XAR, SPDR S&P Aerospace and Defense ETF, PPA, Invesco Aerospace and Defense ETF. Risk considerations: prolonged wars benefit contractors, but quick resolutions trigger profit-taking. Political changes or peace agreements can impact valuations. Current premium multiples may limit upside. Recommendation: allocate 10 to 20% of equity portfolio to defense sector, with plans to reduce as peace negotiations begin. Energy sector opportunities. The closure of the Strait of Hormuz and attacks on Middle Eastern infrastructure have created supply shocks, with oil prices surging. U.S. energy independence beneficiaries: ExxonMobil, XOM, largest U.S. producer; Chevron, CVH, strong cash flow and returns; ConocoPhillips, COP, pure play exploration; Pioneer Natural Resources, Permian Basin leader. Energy ETFs: XLE, Energy Select Sector SPDR; XOP, SPDR Oil and Gas Exploration; IEO, iShares U.S. Oil and Gas Exploration. Natural gas opportunities. European natural gas prices surged 39%, with Qatar shutting down LNG production after Iranian drone strikes. LNG beneficiaries include Cheniere Energy, LNG, largest U.S. LNG exporter; natural gas futures contracts. Strategic consideration: energy is highly volatile. Set stop-loss orders below $70 per barrel for oil-linked positions to limit downside risk. Recommended allocation: 15 to 25% of equity portfolio to energy sector. Commodities and critical materials. Precious metals beyond gold: silver, defense electronics, solar panels, inflation hedge; platinum, palladium, industrial applications, defense technology. Critical minerals: lithium, battery technology for drones; rare earth elements, precision-guided weapons, radar; titanium, aircraft and missile manufacturing. Investment vehicles: mining stocks, Albemarle, MP Materials; commodity ETFs, futures contracts. Cybersecurity and defense technology. Modern warfare relies on cyber capabilities, benefiting Palo Alto Networks, PANW, Enterprise Security; CrowdStrike, CRWD, Endpoint Protection; Fortinet, FRTN, Network Security; and Palantir Technologies, PLTR, Defense Data Analytics. Part 3. Portfolio Strategies and Risk Management. Strategic asset allocation during war. Conservative portfolio. Capital preservation. Cash and equivalents, 15 to 20%. Gold and precious metals, 15 to 20%. Government bonds, 25 to 30%. Defensive equities, 20 to 25%. Defense stocks, 5 to 10%. Swiss franc, 10 to 15%. Profile: capital preservation focus, low risk tolerance, retirees. Moderate portfolio, balanced approach. Cash, 10 to 15%, gold, 10 to 15%, government bonds, 15 to 20%, defensive equities, 15 to 20%, defense stocks, 15 to 20%, energy sector, 15 to 20%, commodities, 5 to 10%, Swiss franc or Bitcoin, 5 to 10%. Profile: balance between protection and opportunity, medium risk tolerance, 5 to 10-year horizon. Aggressive portfolio, maximum opportunity. Defense stocks, 25 to 30%. Energy sector, 25 to 30%. Commodities, 15 to 20%. Cybersecurity or tech, 10 to 15%. Bitcoin, 5 to 10%. Cash, 10 to 15%. Profile: high risk tolerance, 2 to 3-year horizon, active management ability. Rebalancing strategies. Trigger-based, adjust when asset class deviates by 5% from target. Time-based, review quarterly during active conflict, monthly during acute phases. Event-based, adjust immediately after peace negotiations or ceasefire announcements, conflict expansion to additional countries, major infrastructure damage, oil price moves 10% in single day. Risk management techniques. Stop-loss orders, defense stocks, 15 to 20% trailing stops below recent highs. Energy positions, $70 per barrel crude oil reference point. Commodity positions, 2 ATR below entry prices. Position sizing, individual stocks, maximum 5% of portfolio. Sector concentrations, maximum 25 to 30%. Speculative positions, maximum 10% total. Single trade risk, never risk more than 2% of capital. Hedging strategies. Protective puts on equity holdings, covered calls for income during volatility, inverse ETFs 5% max, SHPSQ as short-term tactical hedges. Tax considerations. Tax loss harvesting to offset gains. Wait for long-term capital gains, 1+ year when possible. Place tax-inefficient investments in tax-advantaged accounts. Part 4. Scenario planning and exit strategies. 3 scenarios to plan for. Base case, short-term conflict, 60% probability. Conflict lasts 2 to 4 weeks with limited damage. Oil returns to $75 to $85 a barrel. Investment response. Take 50% profits on defense positions when peace talks begin. Reduce energy to normal 10 to 15% allocation. Increase general equity exposure. Maintain gold as long-term hedge. Downside. Prolonged war, 25% probability. Conflict extends beyond 2 months. Strait of Hormuz closed. Oil exceeds $120 a barrel. Investment response. Increased defensive positions, bonds, gold to 30 to 40%. Maintain or add to defense and energy. Reduce general equity exposure. Consider agricultural commodities. Upside, rapid resolution, 15% probability. Iranian government collapses quickly, energy restored. Oil crashes to $60 to $70 a barrel. Investment response. Immediately exit defense positions. Take energy profits before collapse. Aggressively buy general equities during relief rally. Exit strategy framework. Define exit criteria in advance. Defense stocks. Exit 50% when ceasefire announced. Exit remaining 50% when peace agreement signed. Alternative, 20% trailing stop. Energy positions. Reduce 30% when Strait of Hormuz reopens. Exit 50% more when oil falls below $80 a barrel. Maintain 20% as long-term allocation. Commodities. Take 50% profits when prices hit 2x entry level. Use trailing stops for remaining position. Safe havens. Gold. Maintain 10 to 15% as permanent allocation. Swiss franc. Reduce to 5% when conflict subsides. Bitcoin. Personal risk tolerance determines holding period. Key monitoring indicators. Geopolitical signals. Diplomatic negotiations and mediator involvement. Military operation tempo changes. Regional ally positions. Saudi Arabia, UAE, Turkey. Market signals. VIX declining below 20. Defense sector relative strength versus S&P 500. Oil market structure, contango or backwardation. Credit spreads narrowing. Economic signals. Inflation expectations. TIPS spreads. ISM manufacturing PMI. Consumer confidence trends. Part 5. Psychological discipline and common mistakes. Emotional challenges. Fear and panic. Market volatility triggers emotional selling. Solution. Pre-commit to your strategy in writing. Markets historically recover from geopolitical shocks with positive 12-month returns. Greed and FOMO. Surging stocks create fear of missing out. Solution. Stick to position sizing limits. Chasing performance leads to buying at peak prices. Overconfidence. Early profits lead to excessive risk-taking. Solution. Maintain disciplined position sizing. Take partial profits to lock in gains. News addiction. Constant monitoring leads to overtrading. Solution. Review portfolio at market close daily, not minute by minute. Distinguish noise from actionable information. Common mistakes to avoid. Mistake 1. All-in defense concentration. Placing 50% plus in defense stocks creates excessive risk. Peace can trigger 20 to 30% declines. Solution. Maintain 15 to 25% maximum in defense sector. Mistake 2. Ignoring valuation. Rising stocks aren't always good value. Many defense companies trade at premium multiples. Solution. Take profits on positions trading greater than 30% above normal valuations. Mistake 3. Neglecting hedges. Aggressive portfolios without defensive positions face catastrophic losses if peace arrives. Solution. Always maintain 10 to 15% in gold or safe havens and 10 to 15% in cash. Mistake 4. Fighting the trend. Betting on quick resolution often results in losses as conflicts last longer than expected. Solution. Follow the trend until clear reversal signals appear. Mistake 5. Overtrading. Daily news creates temptation to constantly adjust positions. Solution. Trade only when trigger points are hit, specific prices, specific events, not based on headlines. Investment checklist. Before opening position.
Position size within limits. Max 5% individual, 25% sector. Clear entry thesis documented. Stop-loss level defined. Exit strategy documented. Weekly review. Portfolio allocation versus targets. Stop-loss levels updated. Geopolitical developments assessed. Rebalancing needs identified. Before closing position. Exit criteria met. Tax consequences calculated. Replacement allocation planned. Conclusion. Your action plan. The 2026 Iran-Israel war has created both risks and opportunities. Success requires balancing protection with strategic opportunity. 5-step framework. 1. Protect first. Establish defensive positions before pursuing aggressive opportunities. 2. Diversify always. No single asset class provides complete protection. Combine multiple strategies. 3. Size appropriately. Position sizing determines success more than position selection. 4. Plan exits. Define exit criteria before entering positions, not during emotional market moves. 5. Maintain discipline. Follow your strategy regardless of short-term noise. Key takeaways. Defense stocks historically outperform by 12 to 30%, but carry reversal risk. Energy sector benefits from supply disruptions but is highly volatile. Gold remains the premier long-term safe haven. Swiss franc and Bitcoin offer superior protection against geopolitically driven crashes. Scenario planning and exit strategies are essential. Long-term perspective. Markets typically recover within 6 to 12 months of conflict onset, with patient, diversified investors achieving positive returns. Geopolitical conflicts create short-term volatility but rarely derail long-term returns. The best strategy combines the wisdom of protection with the courage of opportunity, defending what you have while strategically positioning for what's to come. Stay informed, remain flexible, and execute your plan with discipline and confidence. Position size within limits. Max 5% individual, 25% sector. Clear entry thesis documented. Stop-loss level defined. Exit strategy documented. Weekly review. Portfolio allocation versus targets. Stop-loss levels updated. Geopolitical developments assessed. Rebalancing needs identified. Before closing position, exit criteria met. Tax consequences calculated. Replacement allocation planned. Conclusion. Your action plan. The 2026 Iran-Israel war has created both risks and opportunities. Success requires balancing protection with strategic opportunity. 5-step framework. 1. Protect first. Establish defensive positions before pursuing aggressive opportunities. 2. Diversify always. No single asset class provides complete protection. Combine multiple strategies. 3. Size appropriately. Position sizing determines success more than position selection. 4. Plan exits. Define exit criteria before entering positions, not during emotional market moves. 5. Maintain discipline. Follow your strategy regardless of short-term noise. Key takeaways. Defense stocks historically outperform by 12 to 30%, but carry reversal risk. Energy sector benefits from supply disruptions but is highly volatile. Gold remains the premier long-term safe haven. Swiss franc and Bitcoin offer superior protection against geopolitically driven crashes. Scenario planning and exit strategies are essential. Long-term perspective. Markets typically recover within 6 to 12 months of conflict onset, with patient, diversified investors achieving positive returns. Geopolitical conflicts create short-term volatility but rarely derail long-term returns. The best strategy combines the wisdom of protection with the courage of opportunity, defending what you have while strategically positioning for what's to come. Stay informed, remain flexible, and execute your plan with discipline and confidence.